The first and the foremost rule of any strategy designed to follow the trend is to determine the direction of the current market trend. As you know, application of moving averages, as well as other more complex indicators that are based on moving averages, is the most common method used for determining the direction of the current market trend. In order to solve this problem, the weekly envelope trading strategy utilizes an integrated approach with the simultaneous application of two analytical tools. The first tool is a technical indicator called envelope, which indicates the direction of the current market trend, and also generates signals about the beginning and the end of the trend. The second tool is a parameter of average daily volatility of a financial instrument, or ADV for short. It is used for measuring the amplitude of price swings that develop in the direction of the current market trend, or its correction. You can find a ready-to-use envelope indicator in the list of technical indicators provided by the most popular analytical platforms. It is also available in the list of standard technical indicators of MT4 platform. However, the indicator used in the weekly envelope trading strategy is a little bit different. I have created my own version of the indicator, which takes into account the volatility of the financial instrument. In order to create this indicator, I had to use some programming skills in MQL environment. The most common uses of envelope are as follows. The first method. Envelope identifies the areas of support and resistance in a non-trending market. The upper and lower bands of this indicator act as areas where you can expect the price to find support or resistance, before returning to the middle line. While traders may interpret and apply the information in the unique ways, many traders use the envelope in such a way that a sell signal occurs when the price reaches the upper band, signifying an overbought market, and a buy signal occurs when the price drops to the lower band, representing an oversold market. In other words, if the market is truly non-trending, then prices should not spend more than a few time periods near the bands before returning to the middle. The second method. Envelope indicator generates buy and sell signals when market starts a trend. Should the price convincingly break out of the bands, or begin to spend more than a few time periods at the bands, this may indicate that the market is beginning to form a trend. For example, if the market is trending up, and closes above the upper band, this is a buy signal for long entry into the market. The position would be exited if the market closed below the lower band. In the case of correction of the uptrend, it is recommended to open a new long position near the central line of the envelope. Accordingly, if the market is trending down, and closes below the lower band, this is a sell signal for short entry into the market. The position would be exited if the market closed above the upper band. In the case of correction of the downtrend, it is recommended to open a new short position near the central line of the envelope. In the weekly envelope trading strategy, the rules of defining the direction of the current market trend are slightly different from the above. They look as follows. The strategy generates a buy signal when the price breaks through the upper band of the envelope, and the last daily candle closes at the level, which is located at a distance of 300% of ADV and more, from the local minimum value of the central line of the envelope. If after such a breakout, market really starts trending up, then the lines of the envelope start sloping up, and the price begins to spend more than a few time periods above the upper band of the envelope, or in the space between the upper and central lines of the envelope. In this case, traders should look for opportunities to buy until the price touches the lower band of the envelope. That, in turn, would be a signal of the market entering in the state of consolidation. In other words, the signal of the end of the uptrend occurs when the price declines to the local maximum value of the lower band of the envelope. The strategy generates a sell signal when the price breaks through the lower band of the envelope, and the last daily candle closes at the level, which is located at a distance of 300% of ADV and more, from the local maximum value of the central line of the envelope. If after such a breakout, market really starts trending down, then the lines of the envelope start sloping down, and the price begins to spend more than a few time periods below the lower band of the envelope, or in the space between the lower and central lines of the envelope. In this case, traders should look for opportunities to sell until the price touches the upper band of the envelope. That, in turn, would be a signal of the market entering in the state of consolidation. In other words, the signal of the end of the downtrend occurs when the price rises to the local minimum value of the upper band of the envelope.